Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day and spending it with us. We have a fantastic show for you today. We have another great guest to talk to us a bit about the economy. Maureen Harquail from OMVIC will speak to us. We're also doing a show, another show when the Federal Reserve has a meeting coming up at 2 p.m. to make their latest interest rate announcement. Always exciting when we have a show on Fed Decision Day. Here are the list of topics for our show today. As I said, we're going to talk a bit about consumers and car buying. An interview with Maureen Harquail, CEO and Registrar with OMVIC. I had the pleasure of catching up with Maureen this past week. She has an interesting perspective on what's going on, the state of the economy, especially in Southern Ontario, especially regarding sales of vehicles in Ontario. And so a great guest, and we'll also talk a bit about electric vehicles. That'll be an interesting conversation as well. We have our This Week segment where I talk about 3 topics that I think individual investors should focus on before you make your investment decisions. Markets for the last 2 months of 2023. Can you believe we are in the last 2 months, or just started the second last month of the year, November? Boy, time has gone by extremely fast. We'll speak about the last 2 months and see if we could maybe squeeze out some more gains for this year. RBC warns mortgage payment shocks could be a little bit of trouble for the Canadian banks. We're about to see a lot of banks, a lot of mortgages coming up for renewal, and that could mean a little bit of trouble for our Canadian banks if individuals aren't able to meet those higher interest payments. Stagflation. What is stagflation? I know this, our central bank, Bank of Canada, recently has spoken about stagflation. What is it? And is this actually what's happening? Is it a possibility? And lastly, your questions. As always, I like to get to at least a few of your questions before we sign off from the show today. Hopefully we have time to get to a few. And if not, we'll answer your questions either during the next couple of weeks before our next show, or perhaps I will send you a message and answer your question on my own one-on-one before our next show as well. So without further ado, let's move on with the show. I'd like to welcome to our show Maureen Harquail, CEO and Registrar with OMVIC. OMVIC stands for Ontario Motor Vehicle Industry Council. OMVIC administers and enforces the Ontario Motor Vehicle Dealers Act, as well as sections of the Consumer Protection Act. Maureen has been a leading strategic and legal advisor in regulated environments for more than 20 years. Prior to joining OMVIC, she worked with CIBC as a director of anti-money laundering, anti-terrorist financing, AML, ATF policy, served as general counsel and chief administration officer with the Ontario Racing Commission, and also has been an environmental and regulatory prosecutor for the Federal Department of Justice. Maureen has served on several boards and has been a member of the Naval Reserve. I'd like to welcome to the show Maureen Harquail. Thanks for being with us.
Great to be here, Allan. Thanks for having me on your show.
Yeah, extensive bio, I'd say. It's great. You've worked in a lot of different industries, a lot of different places. So it's great to speak to you and try and have a casual conversation as to how things are out there. We always like to tell our listeners, our viewers, how things are faring. And I think you come up with a very unique perspective on things. And so I kind of like to start there. I think for many of our show viewers and listeners, can you tell us a little bit about OMVIC? What do you do at OMVIC? What does OMVIC do every day? Kind of familiarize everybody with OMVIC.
Sure. So thanks for that. And you nailed it certainly at the beginning. OMVIC is the Ontario Motor Vehicle Industry Council, and effectively we're the regulator of motor vehicle sales in the province of Ontario. So the government has delegated to us the authority to enforce and administer the Motor Vehicle Dealers Act, and that's the act that oversees and guides dealers and salespeople on their interactions with the people of Ontario. And there's certain requirements that they need to comply with. And OMVIC is the regulator that oversees that. We're effectively a consumer protection organization. That is our mandate. And we're also responsible for our registrant or our licensee professionalism as well. We have 150 staff. We've got inspectors, investigators, and more importantly for Ontarians, we have a consumer support department that's there to answer questions from Ontarians when they're about to go and buy their first car or their second or third car, or if, unfortunately, they've had a problem with their engagement with a dealer in the province of Ontario.
So and so you guys do quite a bit, obviously. I thought I'd start, I guess one of my first questions would be more a general perspective. Obviously, where you sit, you have a unique perspective on things. What would you say, could you comment on the growth of the industry? Obviously, the industry is very important for us here in Southern Ontario, one of the largest industries. Are you seeing more people entering the industry? Are you seeing more dealerships opening up? Are more people selling cars out there? What are you seeing with respect to the industry as a whole? Are you seeing good times, or are you starting to see that some of these economic, high interest rates, high inflation rates, are you starting to see that cause a bit of a negative spin on what people are doing, what careers, if they're still choosing to be in the automotive sector?
Yeah, it's a really interesting question, and the what we're seeing, in fact, and even through the pandemic, the number of dealers, the number of salespeople has stayed relatively constant. So in Ontario this year and past years, we have approximately 8,000 dealers in the province of Ontario and 30,000 people licensed as salespeople who are actually selling those vehicles. And that number has stayed pretty solid throughout, even during those difficult pandemic days. What we are seeing, and that's kind of sort of the next part of it, is what we're starting to see now. We saw a little bit of it the beginning of 2023, and then I certainly worry into 2024, starting to see some bankruptcies, some failures of dealerships who have overextended themselves and have been overextending themselves. And I think that's the concern, and certainly the concern for the regulator, but also for consumers, because we encourage consumers that whoever they're going to buy their motor vehicle from, that they need to, think before you walk into the door. They can check a dealership's registration status or licensing status on our website. So just make sure you're dealing with that registered dealership, that registered salesperson before you walk in to buy that car.
Yeah, very important, very important. I guess from looking at rising interest rates as we have, obviously inflation still elevated from a level, I guess, the Bank of Canada would like to see us at. From a sales perspective, are you seeing fewer sales? Are you seeing more complaints? I guess complaints would come your way if there were being made. What are you seeing on that front? I guess when people are finding things getting more expensive, higher rates, higher inflation, it's only, I guess, human nature that you might start to see more complaints. Are you starting to see those things?
So it's interesting. What we are seeing is year over year, sales are actually going up. And of course, a lot of that has to do with the fact that manufacturers have been able now to get their production lines, their manufacturing lines going, and have gotten out of that pandemic challenges. So they're able to spit out those cars and get them to the dealerships. And then there's a whole bunch of pent-up demand. So in terms of year over year sales, yes, we've seen increases in sales. That being said, though, what we are starting to see is, again, as I talked about, some dealerships who are finding themselves in some financial constraints. And in terms of consumers and the calls that we get coming in, we're certainly getting some that have concerns about perhaps contracts and bills of sale that they've already signed, and that perhaps they're having some second thoughts. They've signed the bill of sale, the contract with the dealership. They get home and they think, oh, I think I made a mistake. I need to somehow back out of this deal. And the important thing that we tell Ontarians is that when you sign that bill of sale at a dealership, There is no cooling off period here in Ontario. So it's not like buying a condo where you have a 10-day cooling off period. There is no cooling off period in Ontario. And that's so important for Ontarians to understand when they go and buy that car.
I know you must also, those buying cars, I'm sure a lot of them are borrowing to buy the cars. I know that I've had conversations back in 2008 about negative equity in homes way back when, someone bought a home and then all of a sudden they take out a mortgage and the price of the home drops. They go to sell it to pay back the money they borrowed and they can't sell it for the loan value. Is this starting to happen? Are you seeing this happen with cars? Because interest rates have spiked so rapidly. Those that are borrowing to buy a vehicle, are you starting to see this negative equity in these car loans?
We're starting to see some of that, and you're right. A few years ago, in fact, that was more topical. Some of it is coming back again. What we're also seeing too is people taking out loans to purchase those vehicles that are much longer in time. So not for example, the 48 months, they're going much, much longer, which no doubt means that by the time you come back or you want to unload that vehicle, the price of it has dropped tremendously. And right now, of course, vehicle prices are so high and are themselves inflated that you're going to see that it's going to have to happen because eventually some of those prices are going to moderate. And of course, those interest rates, if you're buying a vehicle or leasing a vehicle now, are just exceedingly high. Again, those will come down, and then that negative equity is going to come up even more so. We're expecting it.
Yeah, and I guess for some people, what they do is they just roll that loan into the next vehicle that they purchase, and so it ends up being this spiral of your loan value just keep getting rolled in, and as you keep renewing your lease or your financing deal, do you see this as I guess a bigger problem as we go forward, as long as rates remain at these levels or even go higher?
Listen, it's a vicious circle, right? I think you've touched on it, that, you roll in one car and then you you want to get another car. Some consumers will never be able to get themselves out of this. Particularly, of course, concerned about the subprime area, where people are going to different lenders to get their financing to get a vehicle. Rates are oftentimes even higher. So it's a real challenge for consumers. It's such an important purchase. I mean, we say it all the time, right? It's the second largest purchase most people will make. Sometimes it is the largest that they're going to make. So for us, trying to educate people before they even walk into the dealership to understand the real costs of buying a vehicle and what it could look like in the short term and the long term.
Yeah, and I guess one of my final questions to ask you, electric vehicles, right? I guess that's everybody's interested in electric vehicles these days. It is the future, right? Pretty soon, according to all the auto companies, car companies, they're only going to be producing electric vehicles. Now, we know there are a lot of extra costs that perhaps the buyer doesn't see at times, not aware of. Hopefully they're there. I'm sure you're making sure that they're aware, they're being disclosed. But what are some of those costs, and what should, I guess, people listening to our show, watching our show, what should they be looking for with regards to these EVs?
Yeah, I mean, obviously, the first one is, of course, the upfront cost. And we're seeing that, EV vehicles are quite a bit more expensive than your average combustion engine vehicle. And I think that's one of the reasons, of course, that the adoption rate is not perhaps as fast as governments, certainly our federal government, would likely want to see. I know there's a Scotiabank report out recently that said that, in fact, to get the kind of adoption that the federal government is looking for, the prices of those electric vehicles is going to have to come down by at least a third. And for low-income Canadians, it's going to have to come down by half to really try to get people to go into that dealership and buy that EV. So the upfront cost is really a huge issue now. I think that's part of what's preventing people from going and getting one of those vehicles. Also, of course, looking at the charging infrastructure, I think a lot of people are concerned, it's all well and good to buy the vehicle. How are you going to charge it? And what's it going to cost me to get that installed in my home? Of course, we're also seeing the challenges for, people who live in apartments and condos where those condominium corporations or apartments, they don't even have the charging infrastructure. So what's that going to cost to condo owners, et cetera, to get that kind of infrastructure? Range anxiety, of course, another one for people trying to manage, what does that look like? Can I get to where I want to be? And maintenance and repairs. And I think this is one that people perhaps don't think about. That's that, you get an electric vehicle, there shouldn't be much for repairs, but the reality is they do require repair at one point or another. And the challenge is now at the dealerships and at repair shops is that it takes a special technician to understand what's needed to do the work. So, they don't have enough technicians who have the knowledge and the education to actually do the work. You can't go to your local garage to get that vehicle repaired and maintained, and often requires a very specialized person with special education. So again, something else to think about, because the costs of repair may very well be higher. I guess the other two things, of course, insurance premiums. Oftentimes those new vehicles, those electric vehicles, are more expensive right now. So you're going to have a higher insurance premium. And of course, depreciation, trying to see how that's going to look like in the longer term, how those numbers are going to play out.
And I think, again, you have a great perspective. You have a great seat, I guess, to see how the adoption of EV plays out, how quickly we're going to move to electric vehicles, where really that's all you're going to see on the road. And I know you mentioned affordability from the consumer standpoint. I know from the automotive company, like a Ford, for example, they just reported earnings. And in their earnings report, they said how much money they're actually losing in that area of their business. So they're struggling to make it more affordable for people to buy, because to build, it's costing them so much money. I guess the only company that seems to be making it work right now is Tesla. And you got to look at some of their technology, their efficiency. You go to one of their plants, I heard it's unbelievable with respect to efficiency and the tech that they have there in building these cars. So yeah, I'm not sure how we're going to get to what the government would like us to be, which is a environmental friendly world whereby we're all driving electric vehicles. I don't know if you have any thoughts on that, but it's going to be a struggle. And I think it's going to take a while to really get to that point.
I agree. And I think, in fact, the that 2035 target that the federal government has is actually it's ambitious. And I think that that target relies so much on what the manufacturers can do and what they can deliver very quickly, because right now we're looking at 2%, 3% max right now. We know that consumers are some of them may be going into a dealership to say, I want to get an EV, but they're not able to spit them out fast enough, even in terms of supply. So there's some real challenges to even start getting to we're not even double digits yet in terms of people driving around in electric vehicles. So a lot has to be done. Certainly the infrastructure piece, and I know the provincial government has made some recent announcements in terms of what they can do there to help support that. But again, there's a long way to go.
Yeah, a long way for sure. Maureen Harquail, thank you so much for being on the show today. Much appreciated, giving us your unique perspective on the automotive industry, where it's going, and teach us a little about OMVIC. And I don't know if many people know about OMVIC, but now they do. And again, thank you so much for being with us.
Thanks so much, Allan. It's been a pleasure.
Take care.
Take care.
A great interview with Maureen Harquail of OMVIC. She was great. We chatted for quite some time there, so great to get her perspective. Now's the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions. And as always, we have our 3 topics to consider. First one, third quarter earnings. We are pretty much just past what I believe is the busiest part of earnings season the last couple of weeks, or I guess by the end of this week, I think more than half of the companies on the S&P 500 would have reported earnings in the United States. So third quarter earnings, Fed rate decision, as I mentioned off the top of the show, Federal Reserve head, Jerome Powell, will be speaking to all of us at 2 p.m. this afternoon, and he'll talk to us about their rate decision. Right now, it looks like they will not raise rates. That is the expectation. But what will he say? Are they going to say that there's still a possibility for more rate hikes this year, maybe next year? Or will they give an indication that they think the rates where they are today are high enough to restrict the growth that they want to restrict? They still want the country, the United States, to grow. They don't want to see a recession, but they want to limit that growth. And lastly, patience in these markets. I've been getting a lot of questions recently from investors asking, can we still buy these investment ideas? And the answer is yes, but I think you got to be a little bit of show a little patience, or be patient to see these investment ideas grow for you. So let's talk a bit about the first one, third quarter earnings. And as I said, we've been getting a lot of third quarter earnings. A lot of companies that have been reporting, been reporting really good numbers. Yet many of these companies have been punished by the market. We've seen a sell-off either that afternoon after the market closes and after hours trading, or the next morning, or even for the next day or two. We've been seeing a lot of these companies sell off. And I think one of the reasons for that is that a lot of these companies are saying they are seeing a slowdown going forward, that the earnings expectations for the next quarter or two are perhaps a little lower than what analysts, and as we call it, the street, was expecting. So the companies coming in reporting really good earnings, beating on the top and bottom line, earnings per share growth, revenue growth, but yet guide lower going forward. That's just not good enough, it seems like, for the stock market. And the market is selling off some of these names, and of course, giving us some good buying opportunities. One of the names, one of the charts I have here, we have a bunch of charts to get through. First one here is Citigroup. We talk about Citigroup all the time. Now, Citigroup, interesting enough, is one of those names that reported fantastic results. When they reported earnings, the stock ran higher, a couple of percent higher that day. But here we are, Citigroup back at 52-week lows. Citigroup pays about a 5.5% dividend right now, which is high for a name like Citibank. You're noticing, if you look at the far right, you've seen the stock fall off. Trades at a multiple of like 6 times earnings. A lot of the US bank stocks, and I'm going to show you another one in a second, are trading at 6, 7, 9 times earnings. Again, very low for such a large bank, and a name that has grown and has done as well as it has over the last little while and over the long term. And here's another one, Bank of America. Bank of America I've had on this show many times, and once again, looking at a high back not too long ago in the low 40s, trading at around $26, $27 today. Bank of America doesn't pay as high a dividend as Citi, in and around just under 4%. But once again, really good earnings, but being punished, being punished for what the stock market believes as slower growth to come. And that's why you're seeing a name like Bank of America trading at around 7 times earnings be, punished by investors and sold off. A name we talk about all the time, Meta, or formerly Facebook. Fantastic chart, one of the best performing stocks on the S&P 500 over the past year, but yet still a lot more room to run. And it was interesting how the market perceived Meta earnings. Meta earnings, in my opinion, were one of the best earnings reports I've seen from Meta going back a long, long time. But what the market focused on was, again, what they're predicting for the next quarter. And it was something like they were predicting between 36 cents and 40 cents per share. And the market was anticipating 38. And so maybe it being in the middle of the range wasn't good enough for investors. And they were looking more at maybe it should have been higher. I'm not sure. The stock was punished in after hours trading. Obviously a mistake. Stock actually dipped down into the low 290s. And now we're seeing it back above 300. And I believe today actually is above 300. So a quick bounce back after a sell-off when the earnings came out. We have another chart on Alphabet, or formerly Google. Again, this name was punished because even though they get most of their revenue from YouTube and search, as we all know, their cloud business went from 28% growth to 22% growth. Still pretty good, but below what it reported the quarter before. You couple that with Microsoft saying they actually increased growth with their cloud business. And we heard from Amazon, their AWS, and their cloud business was okay. It made Alphabet's cloud business look weaker, and the stock sold off. This stock was in the around 130, 132, sold all the way down into the low 120s, as you're seeing here. So my opinion is, the reasons for these sell-offs, I just think were overdone and not valid. I think the market took these companies, sold them off for reasons, in my opinion, that I just think were overblown. These stocks are still doing well. I should say the companies are still doing well. Their share prices or stocks are not reflecting how good these companies are doing, like Meta, like Alphabet, like Citigroup. And I just think that represents some good buying opportunities for investors. Second point I wanted to discuss that individual investors should focus on, as I mentioned, is the Federal Reserve and the rate announcement and commentary that we're going to hear this afternoon. And as I said, we're not expecting the Fed to raise rates. And the hope is that really the Fed probably is done when it comes to raising rates. Some may say, well, there's a small chance they may raise in December, and then there's a small chance that they may raise early next year. I think they're done. I think the market, with the yields on government bonds being as high as they are, I think the yields are doing the work for the Fed themselves. And so they don't have to raise interest rates, which actually take short-term rates higher any longer. Again, my opinion. So we have a chart here about Fed funds rate increases since 2022. Now, we've seen this chart before. Most interesting thing about this chart to focus on is June and September, two meetings that rates were not raised at. And if they don't raise rates today, it will be the first time that the Federal Reserve goes two meetings back to back without raising rates in something like almost 2 years. That goes to show you how of an aggressive rate hiking cycle or rate hiking program that the Fed has been in for the last 2 years, that this will be the first time in a couple of years that the Fed back to back does not raise rates. Unbelievable. And that's why we're seeing a lot of pressure on the economy, seeing a lot of pressure on the economy here in Canada as well, because central banks, Bank of Canada and the Federal Reserve, have been in such an aggressive rate hiking mode. And we'll see what they say. I still believe they're going to speak hawkishly or aggressively in terms of saying, we can always raise rates if the data points to raising rates further. But I think they're on hold for the foreseeable future, and possibly we've seen the peak in rates. The third topic I wanted to touch on is this idea of patience in the markets. And I bring this up because investors are asking me the question, Allan, can we invest in the stock market today? With interest rates higher, rates on GICs, rates on high interest savings accounts, money market funds, etc., bonds in general, government bonds, corporate bonds, rates are much higher. And so once upon a time, when we thought that you needed to be in the stock market to make a little bit of money, now with interest rates a little bit higher, you can actually think about buying some of these higher rates or investment vehicles that have or are paying those rates, such as 5%, 5.5%. But I believe, in my opinion, you can continue to invest in the stock market, especially if you're looking for growth. And, when you factor in inflation and taxation, a lot of what you're making on a 5 or 6% GIC disappears, right? It's disappearing to taxes or it gets eaten up by inflation. But there are a number of good quality investments that if you buy them today, I'm going to show you in a minute or in the next few seconds, that over the long term will be fantastic investments. And how do we know this? Because in the past, they've been fantastic investments. And many of these investment ideas, or at least a few of them I'm going to show you today, pay great dividends and have only ever increased their dividends over time. So the first one I wanted to get to, TD Bank stock. Now, TD Bank is a name, and here's a long-term chart. And you can see it's had its ups and downs. But over the long term, you go from the bottom left to the top right. And yes, all the way to the right, we've seen a peak back in, I guess, 2021, and it's sold off a little bit since then. But this is a name I think you could get into today at a significant discount with a great dividend of about 5%. And it's a name you can hold for the long term. And it's also a name I believe over the next 12, 24 months will bring investors good returns in general. Another name that I wanted to outline or to show you, again, stock we've had on the show many times, is Bank of Nova Scotia. And once again, taking a look at it from the long term, chart's not as nice as the one from TD Bank, but once again, you go from the bottom left to the top right, and once again, a sell-off over the last couple of years. Scotia Bank stock now pays in the vicinity of 7.5% dividends. So if you buy the stock and the stock goes absolutely nowhere, doesn't go down, doesn't go up, you're still going to make 7.5% rate of return just from the dividends alone. And another name that I think over the long term can produce some really good returns if you have patience to hold. Another name here outside of the banking industry that I wanted to show, Home Depot, a name we all have grown to love and to shop at many times, especially in the springtime when we all go to fix up our gardens for the spring and summer. Here's a long-term chart of Home Depot. Once again, bottom left, top right, in terms of how the chart looks. A huge spike over the last, let's call it 10 years or so, 20 years or so. And you can see recently, stock is sold off, got as high as about $440 a share. It's now pulled back into the high 200s. So once again, buying a good quality name that pays a decent dividend. You know, Home Depot will pay you in that 3% range. So not as high as the other stocks, but should give you more growth than TD and Scotia will bring. And it's a name you can hold for the long term, and a name that, if you have the patience to own, will produce good returns for you over a period of years or over the next 12 to 24 months. Lastly, I have a name that I've had on the show, Amazon. You know, Amazon, we all love Amazon. I know in my house, we get Amazon packages almost on a daily basis still to my house. We were getting them during COVID times, and now that, you know, we're past the pandemic, we're still getting packages in my house. So Amazon stock, I think we have a chart of Amazon here showing that, again, you look at the chart, bottom left to the top right, sell off a bit, now a bit of a rebound into the 130s again. But again, this is a stock that was as high as 180 after they split. For those of you that are saying, wasn't Amazon a lot higher? Yes, it was a lot higher, but underwent a stock split in the last few years, and that has brought down their share price to more affordable for the average investor. So these are some ideas that, if you're patient, I think will work for an investment portfolio. And when you couple patience in the markets, keeping an eye on the Fed, and third quarter earnings, these are the ideas that I think individual investors should be focusing on before you make your investment decisions over the next couple of weeks. So we just spoke about having patience for maybe a little bit longer term, because at least in the short term, markets are a little choppy, and anything you buy today, you may have to wait a little bit to see the rewards of buying in on the cheap. But let's now talk about markets over the next couple of months, right? We are closing the year off pretty soon. As I said off top of the show, I can't believe it's already November 1st. Can we see these markets rally into year end? Many people believe that the markets may not even make back what they lost over the last 3 months. We've seen a very difficult last 3 months. I think we have a chart here of the S&P 500 again over the, I think it's a 6-month chart. There it is. And you can see how much of a sell-off we've seen since the month of August started, since August 1st. July 31st seems to be, at least for now, the top of the market for this year. And the stock market has sold off about 10% since then. So can we see a market rally into year end? What will be the catalyst? Will it be technology leading the way, or will it be some other sector of the market? Will good news be bad news for the markets, as we've talked about? Meaning if the markets are, or the economy is too strong, the Fed may raise rates, Bank of Canada may raise rates, and we may see a sell-off of the stock market. Or will good news finally be good news, where we actually see growth and the stock market rewards investors for that growth? So these are all questions that everybody's asking, individual investors are asking. And one of the reasons why I think we can see and will see a strong ending to the year is the chart I have here, which shows the S&P 500 average monthly returns for the full year. And we've talked about this before. You can clearly see that coming out of October into November, December, and even into January, February is roughly flat, slightly higher, but roughly flat. You could see some of the best returns of the year. And as I've said on the show, the two worst months for returns are August and September. We've just gone through that. Usually we see a turnaround in October. Didn't really see it. I think two reasons for that. Obviously, the war that started, or unfortunately, what happened in Israel with respect to Hamas and terrorist group, I think that played a bit of a part. We also saw higher yields, which probably played even more of a part in keeping the market down for October. But I'm a firm believer that as we move into November, today being November 1st, we're going to see that turnaround to higher markets. And today and yesterday, markets were higher. Hopefully, that's the start of a bit of a turnaround. So that's the first reason. And I think the second reason why I think markets can move higher is this notion or this idea that the Fed and Bank of Canada are done raising rates. I think if the market can actually understand or get some certainty some way, somehow, I don't know if the Bank of Canada or the Federal Reserve is actually going to come out and say we're done raising rates. But if we can glean this from what they say indirectly, read between the lines, that interest rates are not going anywhere for the foreseeable future, I think that's going to be the catalyst to take this market higher. I think we're going to see the consumer hang in there. We know the consumer makes up about 70% of growth in the United States, and a very large percentage as well here in Canada. Spending hasn't really slowed down. We saw GDP growth for the United States just under 5% last quarter. So I think we're in good shape. All we need are rates to stop rising. They don't have to be cut, but stop rising. And I think we could see a stronger November and December and head into 2024 on a positive note. So RBC recently said that Canadian banks would be in tough over the next year and a half or 2 years, as we're about to see as many as 3.5 million Canadians have their mortgages coming up for renewal. And obviously, if you're in variable rate mortgage, you've already seen your rates increase significantly. I know many investors that have already told me they've received 2-3 letters from the banks telling them that they need to increase payments on their mortgage just to keep up with the interest, let alone, forget about paying anything against the principal. And we know that by 2026, pretty much all Canadians will have their mortgage come up for renewal that have not had their mortgages up for renewal as yet. And we know that, there's still a bunch of Canadians that are still reaping the rewards, or at least enjoying, a mortgage rate of 2-3%. And I think has a lot to do with why we're still seeing the spending happening in our economy. Recently, we have received economic data saying that, GDP in our country isn't growing much. In fact, it's kind of flatlining. And we'll get into that in our next segment. But overall, Royal Bank is concerned. Banks in general are concerned that we could start to see some defaults on some of these mortgages, or perhaps they'll have to negotiate with some of these mortgage holders. And you can see here I have a chart on the prime rate. And prime rate is basically what the banks charge all of us. The Bank of Canada overnight rate is what the Bank of Canada charges the banks. So as the Bank of Canada raises rates, the banks raise the prime rate for us. And you could see here, and this is kind of interesting. And one thought I would leave you with is you can see how much, I guess, the bank rate and the prime rate have come down since the, I guess, the early 80s, which is when we saw double-digit interest rates. And you can see it kind of flatlining between 2010 and 2020, both prime rate and the bank rate, and recently spike higher. And so the last time we saw rates at these levels, you're probably looking at somewhere around 2006, 2007. But at that time, the stock market was still able to move higher. So if the stock market was able to move higher back the last time rates were this high, why isn't the stock market moving higher today? Why are higher rates such an obstacle for the stock market? A question that I've been asking and many have been asking. The only thing I can come up with, to be honest, is the speed of the rate hikes, how fast interest rates have moved higher. And really, it's caught people off guard. It's caught a lot of debt holders, whether it's a mortgage, line of credit. It's caught businesses off guard, how fast the Bank of Canada and Federal Reserve have moved rates. And I think that speed of interest rates rising has really been the big negative. I think once we get some stability there, the fact that interest rates today, prime rate just above 7%, I think that we can handle that. I think the stock market can continue to move higher, even with these rates, but we just need to hear that rates are staying at these levels and will not be moving higher anytime soon. So what is stagflation? Well, simply put, stagflation is rising inflation at the same time as we're seeing slowing growth. And usually stagflation happens when there's a shock to the system. We've seen it in the past with a sudden rise in oil prices. Oil prices can act like an added tax to people. And so if you're paying more at the pumps, you're not having as much money to spend in the economy. So we're seeing growth slow. But higher oil prices can also cause inflation, as we've spoken about on this show many times, to rise. So a spike in oil prices, a significant shock, or significant hike in oil prices can definitely cause stagflation. Today, the Bank of Canada has been talking about stagflation because we've seen a spike in interest rates, yet inflation still remains high. Spike in interest rates causing a slowdown in the economy, but yet inflation remains high. And that inflation has continued to be sticky. One of the reasons I think the Bank of Canada mentioned this past week when they said that they seem to be fighting the federal government. Federal government continues to want to do things, spend money, raise wages. Wage inflation has been an issue at times. At the same time, Bank of Canada is trying to raise interest rates to lower inflation. So Bank of Canada mentioned that perhaps the government and the Bank of Canada are not really on the same page. And that could be one of the problems why we're seeing or we're in the predicament that we are. Bank of Canada still wants to bring down inflation to the 2% level, but they don't want to put us into a recession. And as I mentioned in the last segment, we're seeing growth numbers actually go negative in the second quarter, and many are predicting that we will see a negative third quarter as well. And as we all know, 2 negative quarters back to back says we are in a recession. People are calling it a technical recession, a mild recession, whatever you want to call it. It is possible that the next numbers we get or we receive over the next couple of months could tell us that during Q2 and Q3 of this year, we have been in Canada in a mild recession. Now, does it feel like a recession? Probably not. And that's because most people are working and earning a wage, and those wages have been going up. So for most people, it won't feel like a recession, but technically we could be in one. And we have a few charts here that I wanted to show. First chart, Canadian monthly GDP numbers. And you can see here that we're pretty much at the flat line now, coming down from, January 2023. So just in the last year, you can see how much GDP has come down. And now we're sort of tipping over into the red, into the negative. The next chart that we have here also clearly shows how Canada annual GDP growth rate has come down. You can see here on the far right-hand side, just over 1%. I think we're going to see that go even lower, closer to the flat line as well. You could see last time we saw some negative numbers back in 2020, 21, 2023, obviously, where we're today. I think we're going to see some negative numbers as well. And our last chart here, comparing the Bank of Canada rate to the inflation rate. And you can clearly see that the bank rate now is above the inflation rate. The inflation rate has come down significantly, as I guess peaked back up again. It's gone up a little bit, and I think that has a lot to do with recent spikes in oil prices, recent prices at the pumps going higher, and that has caused inflation to move higher. But the Bank of Canada rate is still higher than the inflation rate, and that tells me that if things do get worse, if the economy does get worse here in our country, that the Bank of Canada has some room to cut rates. And there's talk that interest rate cuts may happen as early as maybe mid-year, spring, summer. So we'll see if that happens. But for now, as I mentioned, as long as we can get some certainty with respect to interest rates, I think we can start to see better growth in the economy. Hopefully, the Bank of Canada does not look at better growth as being inflationary. I think you can have growth and still not have it inflationary. So instead of having little growth and higher inflation, hopefully we can turn it around and have higher growth and lower inflation, the opposite of stagflation. I think we will get there. We just need some certainty with these interest rates. Now the part of the show that I like best, taking your questions. And I know the show has gone on a little bit longer than the norm. We had a great guest off the top. So I'm going to try and get to one question. We'll see if we have time for a second, but at least one question. Let's see here. My investments are currently in index funds with the bank. Is it a good idea to add individual stocks to the portfolio to complement those index funds? I'm not a big believer in index funds, as most of you that know me will say. I think index funds, which pretty much just buys the index, at times it can make sense. But in many instances, buying individual good quality names, picking the winners from the losers, can actually help you outperform the index, outperform the market. And I think, for example, this year, it's true. Had you owned the S&P 500, which is 500 stocks, for example, you'd be up maybe 7-8%. But if you had perhaps a technology bias to your portfolio, the largest component of the S&P 500 is technology. If you had an overweight technology, you would have outperformed the index, maybe produced returns of 15%. I know the NASDAQ is somewhere around 22% return for the year. So you probably come in somewhere in between the S&P return for the year and the NASDAQ. Look at the Toronto Stock Exchange. If you bought an index fund that followed the Toronto market or even the Dow Jones, you'd have no returns. Pretty much the TSX for this year is flat, slightly negative even, a couple of percent below right now in the red. The Dow Jones is basically at break even for the year as well. So by picking names on the TSX and on the Dow and on the S&P 500, you could build a great portfolio out of good quality names that are cheap, that are paying dividends without having to buy the whole index. And that's where an investment advisor comes in. If you have an investment advisor today, they should be helping you pick those names, build that portfolio from scratch to meet your needs and your objectives today. Not buy you something that, perhaps worked 6 months ago, but buy you something that works today. So I know we're running out of time. So with that, I think I'll leave it at one question today. I will try to answer some of the other questions over the next couple of weeks or maybe during the next show. But again, I wanted to thank our guest, Maureen Harquail, for joining us. In 2 weeks, we're going to have a fantastic show on Wednesday, November 15th at 12 noon. we will have the Ontario Finance Minister, Mr. Peter Bethenthalvey, will be on our show to join us. We're going to talk to him about interest rates, talk to him about inflation, talk to him about everything to do with the Ontario economy, what the Conservative government can do to improve it, to help people get by during these difficult times. So a great show, and I look forward to it. And until then, happy investing.